Hi, good, afternoon now, ladies and gentlemen. My name is YJ. I'm from Arcane Capital, and we are a boutique fund management firm that has two funds, one in Luxembourg, one in Singapore, and we are fully focused on renewable energy. So today I'm here to talk about investing across the energy transition space. Just a little bit about ourselves. The company was founded by Mr. Christopher Rathke. He's actually sitting right there in the front row. As you can see, he has 37 years of experience in fund management. That the head of entire bright silver hair sort of gives that away. Myself, I have 14 years of experience in the fund management and investment research space. And a little bit about our fund. This is the current existing fund in Luxembourg. Chris started it in 2009. And since then, over the last 15 years, we have delivered about 241% cumulative returns over that period. That translates into a return of about 8.2% per year. By comparison, S&P Clean Energy Index and the Bloomberg Alternative Index actually are down over the same period. So we have outperformed the indices. These are not our benchmarks, but just relevant indices by about 9 to 10% per year. And because of that, we have won a couple of fund awards in Germany in 2022 and 2023. Today, I'm just going to talk about three broad themes. I'm going to spend most of my time talking about the energy storage space, and then the lithium space, and a little bit about silver, and why I think this space has some very, very interesting investment opportunities. I hope that you'll hear something today that differs a little bit from the standard narrative out there in the market. So just take a look at the big picture overall in the world. Energy sources grow over time, but what has really skyrocketed are solar and wind. These really took off on an exponential pattern since the late 2010s, and it is not stopping at all. By actual installations, solar has gone absolutely ballistic. In 2017, 2018, we were talking about 101, 106 gigawatts being installed across the world. And last year, that jumped to 444 gigawatts. This year, even after that huge increase, we are still expecting about a 33, 35% increase to almost 600 gigawatts of installations around the world. And this rapid growth has taken just about every forecaster out there by surprise. The chart on the right is basically IEA's forecast of solar installations over time. And you can see conservative, straight line, flat forecasts simply don't work. It goes exponential, it is S-curve. These are the sort of patterns that technologies, when they really hit a certain tipping point, how they go. Now, with that much solar being installed around the world, what has that done to electricity grids around everywhere? This comes from California, and it's called a duck curve. Why? Looks like a duck. And you can see from 2015, the middle of the curve has got progressively deeper and deeper as more solar has been installed. And that simply means that less and less power in the midday is required from non-solar sources. And to that extent, it has gone negative last year, slightly negative last year, and you can see the same the same pattern happening across multiple countries in the West, right? So this is a map of Europe, and you can see France, Germany, Belgium, Denmark, Norway, Finland, Sweden, all reporting negative wholesale prices in 2023. And not just a little bit, not just a few hours. You can see France and Germany, okay, 147, 301 hours of negative power prices in last year. Up north in the Scandinavian countries, 400 plus hours. I'm very, very surprised by this. That means that about already 5% of the entire world, of the entire number of hours in the year were negative for those markets. And they're still adding more solar. How do you add more solar when power prices go negative, right? The only way to do so is by putting in battery storage. You have to load shift this excess capacity, this excess production in the middle of the day from peak production period to peak demand periods at the end of the day. So over time, we have seen a steady and exponential growth in the size of BESS, battery electric storage system, all around the world. 2017, we were talking 200 megawatt hours. 2021, 450. Then we suddenly see huge ones in California, 1.4 gigawatt hours, 3.3 gigawatt hours. And we are talking even larger ones today. The news just came out recently. There was a recent award for about 8 gigawatt hours. But all that sounds huge. But against the scale of solar installations, it is a tiny fraction of what is needed, and what are actually being installed is a tiny fraction of that still. This year, remember, we are saying about 500 to 600 gigawatts of solar being installed. This is my model. I'm conservatively modeling 550 gigawatts and about 180 gigawatt hours of storage. That means that today, this year, we are installing 20 minutes of storage based on the new solar installations being put in. 20 minutes. By the time of this presentation ends, those batteries are full. Not enough. In my model, we model these installations growing to about 1 hour of new installations by the end of this decade. So about 1 terawatt hour versus 1 terawatt of solar installations. What does that do? But okay, pop quiz. Anyway, before I go there, pop quiz. Just quick show of hands around the room. How many of you think that to shift 3 hours of midday storage to the end of the day, how much of the world's lithium supply will be consumed? For those of you who think A, 35%, show of hands. Nobody. B, 45%. Nobody. C, 55%. Still no takers. Wow, this is a very informed. Then D, 60%. We have some, but you are still wrong. The answer is E, everything. So let me tell you why. 600 gigawatts of installations multiplied by 3 hours, that takes us to about 1.8 terawatt hours of batteries. How many terawatt hours of batteries are being produced this year? About 1.6. To install just 1 hour of storage in 2030 takes more lithium than is being produced in the entire world today. That is one key point I want to drive across here. So then let me move to the supply-demand picture of the market and how we think about it. To do this, what we do at Arcane Capital, we actually track 96 lithium companies with firm mine plans, and there are 114 mines that are in production, in feasibility studies, in development, or have a very, very firm timeline to production. You'll notice that these numbers are significantly higher than what all the other analysts out there are putting. And I'll go into a little bit more detail why. But before we go there, let's talk about battery prices and how that has evolved over time. So this is, of course, Elon Musk's first Roadster, which he has now launched into space and is orbiting the sun. It has a 54 kilowatt hour battery. When he built it, it cost about $80,000 just for the battery pack alone. Today, that same battery pack costs $4,000. Prices have collapsed 95% over this period from 2010 to 2024 today. Why? In 2010, gigafactories were a new thing. It was the buzzword. And gigafactories just means that factory has 1 gigawatt hour of production capacity. Today, new gigafactories are coming online, being built at 100 gigawatt scales. And that means that economies of scale have massively come into play. Even though lithium prices can be high, battery prices can still be falling over time. And that means that this year, 2024 to 25, we are seeing EV prices go below ICE prices. In fact, just this morning, I read an article in an Australian newspaper This MG4 has been discounted to just below 31,000 Aussie dollars. That's how cheap it has gone. It has gone way below internal combustion engine prices. In our model, we forecast EV penetration to rise from the current 20% this year to 44% in 2030. This is not an aggressive assumption. Some other analysts out there can be a little bit higher. And based on this, we estimate 2.2 million tons of LCE, or lithium carbonate equivalent demand, coming from EV passenger cars. Again, this is not high at all. Albemarle, the largest lithium producer in the world, this is their forecast. By 2030, they say the lithium demand will be 3.3 million tons, out of which, as you can see, the largest chunk there are EVs. So the picture is about the same. We have a large chunk there, about 2.2 million tons. Albemarle has about 2.6 maybe in EVs. But where we think Albemarle is severely underestimating things are in the grid and other demand sources. Some of them are here. The demand sources that are not being considered in EV passenger cars, which is what everybody's focusing on. EV buses. Each of these buses come with 300 kilowatt-hour batteries. By comparison, a single passenger car has an average battery size of about 70 today. So an electric bus has a battery about 5 to 6 times that of a car. And we forecast about 400,000 such electric buses to be sold by the end of this decade, with a penetration rate of the bus market of only 21%. E-trucks, Tesla Semi, BYD heavy trucks. These come with even larger batteries because they need to hold a much higher load, much heavier load over a much longer distance. And these trucks come with 600 to 800 kilowatt-hour batteries that makes them 10 times the size of a given car. We forecast 500,000 unit sales of e-trucks in 2030, and that takes the penetration rate to only 13% globally. But what does 500,000 units of trucks actually mean? It's equivalent to 5 million cars, and the car penetration forecasts by 2030 about 45 million. So the truck demand alone could be a tenth of the EV market demand. And I've mentioned already, electric BESS. If we want to do 1 hour of storage, we're going to use all the world's lithium being produced today. So stack this up into our demand forecast, and you can see by 2030, yes, we are about 3 million tons at the 44% new car demand level. Okay, we are in line with the market, sure, with Albemarle. But once you add what we think are the new bus trucks and new truck sales that are electric, plus the solar installations, that's going to take demand to over 4 million tons. There are simply not enough mines in the world to deliver that kind of supply. Talking about supply, it's being delayed. Danfeng, delaying. Thacker Pass, delays. Arcane Lithium has put their Mount Catherine into care and maintenance, which is a nice way of saying shut down. EATL, delay. Actually, they said it's adjusting, but actually more or less they are probably likely to shut down most of the mine. Piedmont has been delayed. Core Lithium, care and maintenance as well, and they literally just came to first production last year. So here, this is our potential supply chart and how we compare our forecasts from February this year to the current forecast. And just a note, this is not what we actually expect supply to be over the rest of this decade. These numbers are entirely unrisked, which means if the company has a plan to put out this supply by this year, we put it in the model. If they say they're going to delay it, then we delay it 1 or 2 years. It assumes that lithium prices are sufficient to bring these to production. But even so, under the current low lithium price environment, companies globally have cut back supply for next year by 17% and for 2026 by 21%. The only place that has registered a positive surprise comes from the brown bars there, which is actually Africa. This year is up 41% versus our original expectation. But even in future years, the growth in Africa is quite muted. Who knows? The Chinese could surprise us on their supply side again in Africa. They've certainly brought new mines to production far quicker than we thought was possible. But Africa, a large chunk of Africa produces low-grade materials. Okay, what comes out of Zimbabwe, Namibia, have tended to be around the 4% grade, not 5.5 or 6% spodumene grade. But here, this supply chart is something that we did ourselves, and we did a deep dive analysis into the Chinese lepidolite industry. We went into these, their Chinese sources, the company's official accounts on WeChat and Chinese news media. Some of those that did not disclose, we tried to calculate their costs based on the grades at the individual mines. So what you can see here is that this is the supply curve, the cost curve as of last year. At the current price of $10,000 per ton, 60% of the supply is not even cash positive. The lepidolite industry for China next year can expand. The production nameplate capacity is there, up to about 300,000 tons of lithium carbonate. But a lot of them sits well above the current $10,000 cost price that they're getting. And just now remember, we said that CATL was adjusting its production and potentially probably shutting down the whole mine. CATL is right at the 200,000 mark. It is Ningde Shidai right there. And if CATL, they are the world's largest battery producer. They consume their own lithium. They are the one with the vertical integration subsidy narrative. If even CATL is shutting down their mine, I don't think any one of those to the right will produce. So that's what I want to say for lithium right now. Okay, let me move on to silver quickly. Silver, what not many people know is that it is a market that is being heavily driven by the solar industry right now. Why? You see those bright lines on the solar panels? Those are actually little lines of silver. And every solar panel consumes a tiny bit of silver. But when we are talking about gigawatt scale plants, this is the Noor Abu Dhabi plant. This is a 1.3 gigawatt solar plant, and it consumes about 30 tons of silver. The world this year is installing 450 times this volume, right? I mean, the numbers just become literally unimaginable. So what does this do? Solar as a percentage of global silver production has gone from nothing in 2000 to about 16% or slightly higher last year of the world's silver production. What is happening? This year, installations will be up 35%. Next few years, it's going to grow from 600 to 800 to probably a terawatt by the end of this decade. It is doubling again. And what we can tell you from our in-depth research into the solar industry is that the next generation of solar panels, which are called TOPCon, and the next one, heterojunction, use even more silver per panel. That just means that the demand from the solar industry as a percentage of the world's silver production is going to grow from 16% to 32 to 40%. Now, the only industry that I'm aware of the only metals industry that I'm aware that has seen a single industry take over the production is lithium. And we know what happened to lithium prices in the last cycle. Can silver supply adjust like lithium did? The answer is generally no. Silver production is mostly a byproduct of gold copper mines or lead zinc mines. All of these gold, copper, lead, zinc mines, the entry ticket to them is $1 billion. You don't start one of those without $1 billion. Only about a third of the world's silver are being produced from pure play silver mines. That means that silver itself as a metal is hard to grow in terms of supply. And we are already in a deficit. So this deficit is expected to actually persist until the end of the decade. Now, at the fund level, how do we approach our investments? All right, what you have heard me share are all the big trends and things that drive our investment thesis. Okay, what we need to understand before even deciding to go into a sector or choosing companies to invest in. It probably doesn't come as a surprise that I like the lithium industry, especially now that prices have collapsed. The large caps are down 67%, the small caps are down 80 to 90%. If you want a bottom fish, this is the time to do so. On a price to book, the lithium large caps are down to even below the previous cycle lows. On an enterprise value to invested capital basis, which is how we think about replacement value, it is approaching replacement value. And for some of the small mid caps, they are already well below that. So this is how we actually do our supply modeling. All right, we take every single mine in the world, give it a roll, and we forecast how much that mine will produce through 2030. So as you can imagine, with about 114 mines around the world, this gets a little bit cumbersome, but we do it. And from the ground up, how do we select individual companies to invest in? We look for a good resource, we look for trustworthy management, a clear financing plan, a healthy project timeline that doesn't have first production in 2031 or 32, and we look for volume growth, which means that even in the absence of any price growth, we can expect volumes to grow, and therefore the company should report stronger revenues and profits over the next few years. And we look for potential exploration upside. What you see here on the right is an example of our discounted cash flow model for two of the mines in one of the companies that we invest in. I'm not going to give any stock tips away today. I'm legally not allowed to, but this is our process. And for this particular lithium company, how much they're going to be producing today will grow about 3 times to 2030. And based on a quick calculation, at $25,000 per ton lithium carbonate price, this company should deliver about 53% of free cash flow compared to its own market cap by that time. Given that most companies trade at 5 to 10% free cash flow yields, we think that this company the price could go up 5-10 times. And we discount all these mines at 12 to 14% for producing mines. And for those that are not producing, we discount at 16 and even 25% to effectively zero them out. Even then, with such high discount rates, we still have 162% upside for this particular company. That's how bombed out this sector is. All right, so just to wrap up, the key takeaways from the two sectors that I've discussed today: lithium, demand is severely underestimated. Supply growth has been postponed and still continues being postponed. And battery storage still requires lithium. There is no alternative right now. Silver, same thing. Solar demand should trigger a price spike. There's a lack of substitutes, and it is very difficult to increase supply. A quick mention about the fund that we just launched in Singapore. It is called the Arcane Green Metal Fund. It is the first of its kind in Singapore. And we aim to deliver, as you have heard earlier, pretty strong capital appreciation over the next few years. And I actually have set for myself a personal goal to beat the track record of the current fund. All right, so if you want to find out more, you can speak to me later. And if you scan this QR code, you'll be taken to add my contact, my email address, and potentially follow me on Twitter, where I actually post a bit of research every now and then. So that's it for me. Thank you.